What are the tax implications of owning property in an irrevocable trust? Have you ever wondered how owning property in an irrevocable trust affects your taxes? This is an important topic for anyone involved in real estate investing. Let's break down the tax implications in a straightforward way. First, when you transfer property into an irrevocable trust, you give up ownership and control. The trust itself becomes a separate legal and tax entity. This means it has its own tax obligations. One key area to consider is capital gains tax. If the trust sells the property, it must pay capital gains tax on any increase in value from the time the property was placed in the trust to when it is sold. The trust files its own tax return using a unique taxpayer identification number. Trusts can face higher capital gains tax rates than individuals, which can be a surprise for many. If the trust distributes the gains to beneficiaries, those beneficiaries will report the gains on their personal tax returns. Next, let's talk about income tax on trust earnings. Any income generated by the property, like rental income, is taxable to the trust unless it is distributed to beneficiaries. If the income is distributed, the beneficiaries will report it on their personal tax returns. The trust must file an annual income tax return to report all income and deductions. Another important point is the loss of step-up in basis. Normally, when someone inherits property, the cost basis is adjusted to the fair market value at the date of the original owner's death. This can help reduce capital gains tax if the property is sold later. However, assets in an irrevocable trust usually do not receive this step-up in basis. This means beneficiaries might face higher capital gains taxes when they sell the property, since the basis remains the original purchase price. Estate tax considerations also come into play. Property in an irrevocable trust is typically removed from the grantor's estate for estate tax purposes. This can lower estate tax liability. However, it also means the property cannot benefit from certain tax exemptions tied to personal ownership, like the primary residence exclusion on capital gains. Now, let's look at property tax implications, especially for seniors. Placing property into an irrevocable trust may affect eligibility for property tax benefits, including senior property tax relief programs. Some areas requiring the property to be owned directly by an individual or irrevocable trust to qualify for these exemptions. It's essential to check local rules to see if any property tax benefits are lost or retained when changing ownership to an irrevocable trust. For real estate investors, using an irrevocable trust can protect property assets from creditors and lawsuits. However, the trust's tax rates on income and capital gains can be higher than individual rates. Distributing income and gains to beneficiaries may be more tax efficient. The lack of step-up in basis can increase capital gains tax when the property is sold, which can impact overall investment returns. Balancing estate and gift tax planning benefits against potential higher taxes is crucial. Consulting with an estate planning attorney and tax professional is essential to tailor the trust structure to your investment goals and tax efficiency. Owning property in an irrevocable trust creates distinct tax consequences that real estate investors must carefully consider. Understanding these implications can help you make informed decisions about your investments.